here in this segment, we're going to turn to Asia, and we're going to start with China. Now, one of the things that you can kind of see from the chart, and we'll take it from the top down, CPI continues to slow. It was expected to be up 0.2, came in flat. PPI, pulling back. The bigger issue that we see here is when you look at exports, imports. So one of the big pieces, and remember, imports are very important when you look at those leading indicators. And imports year on year came in on the CNY side came in at negative 0.8. Exports came in at negative 0.6. And then when you look at those, the imports in general on the US dollar side, it was expected to be down 6.3, came in down 6.2. So again, all of these pieces continue to point to more problems when you look at just exports. And it's not that they're collapsing, because exports were a little bit better than expected to be down 8%, came in down 6.2. So again, just kind of this balancing act in general, where it's not growth, but it's not terrible. And then when you start looking at some of the other pieces, so money supply for M2 got a bit below estimates at 10.3%. Money supply for M1 expected at 2.4, came in at 2.1. And all of these things is, again, pulling things down a bit. And that's where, 1 year lending facility was slightly better than expected at $789 billion. But now when we turn to the economic side, so GDP year on year expected at 4.5, came in at 4.9. GDP quarter on quarter expected at 0.9, came in at 1.3. GDP year to date expected at 5, came in at 5.2%. One of the things that we've talked about is we do expect this to come back down. So industrial production came in at 4.5%. Retail sales expected at 4.9, came in at 5.5. But one of the things, and we talked about it last week with Golden Week, is it's actually slowed down considerably since this point. So now the good thing is consumption was a big driver to the beat, but now the consumption's going away, or at least slowing, while the problem points that have been there, fixed assets expected at 3.3, came in at 3.1. Property investment expected at negative 8.9, came in at negative 9.1. Residential property sales expected to be flattish, came in at negative 3.2%. So again, all of these things are pointing to more problems, with new home prices coming down another 30 basis points. So again, all of these things are problematic when we look at, if consumption slows, which it has based on the current indicators from October so far, Golden Week. It just means that we're something closer to 3.5%, 4% GDP growth, which is what we've been saying. It's not that they're not going to grow. It's just going to be at a much cooler pace. So looking at some of the Trivium comments, China's economy outperformed expectations with an uptick in growth. Real GDP came in at 4.9%, down from 6.3% growth, but again, beating consensus of 4.4%. More importantly, the sequential economic activity accelerated, coming at 1.3%. But again, we do see that cooling off a bit. But when you look at some of the problems with some economic warning signals, nominal GDP growth, which typically translates more directly into how businesses experience the economy, decelerated to 3.5% year on year versus 4.8% in Q2, which is consistent with what we've seen from China Beige Book, with what we've seen from some of those leading indicators. Q3 performance was driven in large part by improved consumption, which again, we've seen cool off as we headed into Q4. Well, this number includes both government and household consumption. Policymakers have seen calling for consumption to be better. Some of this, as we've said, is being more government driven, because we still see that lag on the consumer side. So while the economy is by no means on sure footing, officials are feeling a bit better. And this is why it's unlikely to unleash this huge new stimulus, which is what we've been saying, is it's going to be in this problem point, if you will, where it's good enough to not need stimulus, but yet not to a point that the market expects. And I think that balancing act is going to be problematic for people to kind of, take in and understand. The Belt and Road Initiative, China's policy banks' new overseas loans have slowed. They have tried. Xi actually, I think it was yesterday, or the day before, announced that they're going to increase some of these loans. New memberships have also fallen, and a lot of that, as you can see, it wasn't just COVID. They started to fall before that because there was a leak on how many problems things are, what the problems are, and just what you can call as, debt diplomacy, which is a bigger issue when you look at, they give you the teaser rate, and then by the time you're getting the second, third tranche, that is moving up exponentially. And so there's been a hesitancy to get into this network. And especially when you start looking at the problems that China has. And again, this is a way for them to try to, invest in the country based on the BRI terms. All of that investment money for these has to come and be purchased from Chinese companies. And this is going to become a problem point. And you can see how it's dropped off, especially in 2023. And so by trying to reinvigorate that, they're going to try to do things to, again, prop up the economy from an industrial standpoint, from another angle, which this is one of them. But I don't think it's going to be successful, just given based on the hesitancy that now countries have getting into this network. So ahead of the competition, actual BRI spending versus planned Western investments, you get an idea in terms of some of the shifts in general. So again, the BRI has been more willing to put money to work, which is why people are still entertaining that. Good for business. Most of China's overseas contracts are with BRI countries because, again, if you take BRI money, you have to buy BRI sanctioned or Chinese sanctioned products or companies. So it's no surprise to see that correlation. The problem is the all completed overseas contracts, again, you can see has dropped. And realistically, Xi needs to find a way, or the CCP has to find a way to reinvigorate that, to try to make up for some of that loss, because realistically, this is going to be a longer term issue when you look at that hit to GDP growth. Now, when you look at China GDP quarter on quarter, you can see, again, kind of bouncing around year on year. I'm slowing down, but again, still better than expected. And we do see some additional cooling, as we've already highlighted. China industrial production, flatlining with, look at Chinese retail sales, they normally get better. The thing that we've talked about in October is we actually saw October disappoint, given the level of travel was up 4.1%. But yet spending was only up 1.7%, which again is showing that more people traveled, but they all spent less. And then putting that into 2019 terms is a much bigger issue. All the while, new home prices fell again, with China property investment continuing to disappoint and actually hugging closer to right around 2018 levels, which you're seeing that pressure. And unfortunately, when you look at the consumer and the consumer's impact, the consumer has, 65% of their net worth is tied to new home prices, property investment. So as these dwindle or at least languish, you're going to see more pressure on new investment, the consumer spending, which is what we, I think, saw in Golden Week. We thought Golden Week was going to be kind of the last surge and then a disappointment going forward. Instead, Golden Week in itself was a disappointment, which again doesn't bode well for the rest of Q4. Then when we look at China's credit growth slowed this year, it's not surprising. This is what the PBOC is trying to do, is again manage what that credit growth looks like. What we've been saying is that the credit impulses they were gonna try to keep it between -1% and 0%. And that's because there's too much liquidity out there trying to slowly pull that out, which again is what we're seeing on a more realistic basis when you look at the credit impulses, is gradually trying to move that down. Several measures to spur people to buy more homes, such as lowering down payments. The additional support for the economy came as China's post-pandemic recovery has lost steam. Exports have been falling, including, so what are they trying to do? Again, including custom mortgage rates, but it doesn't matter, because if there's no demand, it doesn't matter where you put rates, because people don't want to take the additional leverage, which is what we continue to see. When we look at share of state-owned enterprises in China bond issuance, they continue to be the main driver of the SOE ratio of close to 95%, which is a bigger negative when you look at and why Xi is trying to push so hard on the private sector, saying, oh, we need the private sector, we need this, we need that. That, again, is going to be an underlying problem, only because they're already over-levered. And even though you're cutting rates, there's no desire to lever further. In 2023, China shows more symptoms of Japanification than before the pandemic. And that's something that is a structural problem And as they focus more on SOEs, you're leveraging more and more into, again, a controlled society, which obviously communism pushes for, but you're seeing the failures and inefficiencies and whatnot. So that's where they're trying to bring back that private sector. But after doing a very good job of enticing people to come back between 2013 and 2020, now, there's been another crackdown on patents and the ability to hold IP. There's been an issue on, the ability to get support from the government, with a lot of it going towards SOEs, which is going to slow down people moving back towards the country. Now, when we start looking at some of the underlying flows, China has been increasing exports into the U.S., but utilizing some pass-throughs, if you will, whether that be Thailand, Cambodia, Vietnam, and it's ways to just try to get around sanctions. It's naturally going to happen just because some Chinese entities may open up a factory in Vietnam, in Cambodia. They'll bring the semi-finished goods from China there. They're technically assembled in that region, so then they can move forward. Again, something that happens during this nearshoring, onshoring side. So again, very common to see at this point in time. China 1-year lending facility volume, you can see that it typically kind of drops down, but they've tried to pull some of that forward. Monthly new loans had a nice little bounce, but again, when you look at it on the survey side, so survey was for 2.5 trillion yuan, actual came in at 2.3. So they're increasing lending facilities, but yet they are struggling to get the new loans where they need them to be. As I've said, people are pulling back and trying to reduce their leverage ratios. China aggregate financing pushing higher, even as the money supply slows. And again, a lot of that is levered towards SOEs, and it's not having the impact that Xi really wants, or the PBOC CCP wants, which is why we expect to see more rhetoric and more push towards the private sector, which we do believe falls a bit flat. Now, when we look at India, industrial production expected at 9.1, came in at 10.3. CPI expected at 5.4, came in at 5.02. Imports came in at negative 15%, which again is that negative leading indicator. Wholesale prices came in at negative 0.26 versus the estimate of positive 0.4. So we should see technically a bit more deceleration on the wholesale side. Food prices spiked back up, which is keeping CPI a bit elevated. But the bigger concern is the import side. And we've been saying that we've seen some slowdowns in India, but they really haven't come through on a PMI side. But they continue to show up on an import side. And that's what is our biggest concern. And it's not that India is going to go into contraction. Absolutely not. That's not what we're saying. It's just, growing at a PMI of 62 is more, when you look at some of the underlying data, it's closer to 57, 58, which is still strong, just not to that level. So again, we do see some of that pullback. South Korea, import prices, still staying fairly elevated. When you look at money supply, again, cooling off as they try to stay ahead of the inflation, with the Bank of Korea keeping the base rate at 3.5% as expected. India trade balance, you can see here, expected was supposed to be negative 23, came in at negative 19. And that was because, again, imports were down. But when you look at the imports level, we're now below 2022, below 2021. There's typically a bit of an increase here, but now you're starting to see that slow. We don't see a huge drop. We're just giving you an idea of where we expected of, a little bit more pressure to the downside in the near term. Japan PPI slowed a bit, but again, still remaining on the higher end. Month on month came in at negative, which is a good thing for what they're trying to see. But machine orders were negative. That's a problem. The bigger thing that we want to point to is industrial production, coming in negative. And then as you start looking at exports, imports. So when you look at what the BOJ needs, they need dollars coming in. They need some support coming in. But imports were supposed to be down 12.7%. Instead, they were down 16.3%, which again is on a leading indicator basis, a much bigger problem as Japan continues to buy stocks, continues to buy bonds, and just look at the size of which they're buying as they're trying to get in front of and trying to, again, hold steady on their yield curve control, as well as the yen, which, again, is going to continue to be an underlying problem as you see these pressure points continuing to mount. So that's what we have for you today. If you have any questions, we'd love to hear from you, and we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.